silver prices are going to go down. Okay, maybe gold goes to 3,500. Right now, I still think that many people are in disbelief of the current prices.
What's your base case for silver for 2026?
You had this big selling in gold and silver when gold was above 5,500 and silver was 120. I think the government may have orchestrated that because they were worried about the message that soaring gold prices were sending. Seeing silver, swing, drop $10 in 5 minutes. The important thing is, where is all that volatility taking place? $80, $85, $90 down to $70, $75. Way above what used to be resistance at 50. So we just blew through the double top area.
Data from the COMEX, LBMA, Shanghai, they all show depleting supply levels over the last year. Modern civilization and military require silver. There's just no alternative.
When price goes way up, it's not like the mines could just supply a bunch more silver. Some Americans that are in a lot of trouble. And if they can get 25, 50 grand by selling their fancy silverware, I think foreign central banks have already made the determination, at least some of the banks, and I think more banks will follow, but they are determined to replace dollars with gold. That gold is going to be their primary reserve asset that they hold. Whatever the coverage this is going to end up being, this is the trend. And central banks still historically own a low percentage of gold in their reserves. You have a few countries, like the U.S., right? We mostly have gold. And some of the old guard, Germany, Italy, these countries still have a lot of gold relative to their total reserves. But, the emerging markets, it's still a tiny fraction. They're mainly loaded up with dollars. And most countries have mostly dollars. And there were some countries not too long ago that were selling down their gold.
Canada?
yeah, Canada, the UK, Switzerland even sold some gold, But that's not happening anymore. The central banks, obviously those that sold, regret it. They clearly made a big mistake in selling gold. And so more central banks are going to be buying gold. And the ones that we're buying are going to keep buying.
Central banks don't reverse decades-long reserve strategy shifts unless something deeper is breaking in the monetary system. As Peter Schiff argues here, global reserve diversification away from the dollar reflects structural risk, not speculation. Central banks bought over 1,000 tons of gold in 2023, one of the largest accumulation years on record, while US Treasury holdings by foreign governments have quietly declined since 2021. Emerging markets still hold less than 10% of reserves in gold, meaning reallocation alone could drive demand for years. Peter Schiff sees this as slow-motion monetary realignment. Next, private investors begin noticing the same shift central banks already acted on.
Do you believe it's in the best?
And the other thing that's happening, though, is that for the last several years, central banks pretty much had the market to themselves. The public was selling. Investors were selling gold. And that made it easier for the central banks to buy it. But now I think the private sector is just starting to recognize the value of gold and understanding that it needs to be a part of a portfolio. Now I don't know whether it's 2%, 5%, 10%, whatever, but it's going from zero.
Right.
And so, this is just started. They used to laugh at me and make fun of me when I used to go on financial television and talk about gold. But now, the people that go on, they have some people talking about it, and, they're respected. They're taken seriously for recommending it. And I also think, a lot of the institutions that may have put their toe in the crypto pond, because they were looking for some type of alternative to the dollar, a safe haven, a gold-like trade, and they got conned into the digital gold scam. I think that's pretty much blown up.
Markets often shift direction long before retail investors realize the narrative has changed. Peter Schiff highlights a classic cycle. Institutions accumulate while the public exits, then retail returns late in the trend. Gold ETF outflows dominated much of 2021 to 2022, while central bank purchases surged, a divergence rarely discussed on financial television. portfolio allocation matters more than prediction. Moving from 0% gold exposure to even 5% globally would represent trillions in potential demand. The crypto as digital gold thesis weakened after the 2022 liquidity crisis exposed correlation with risk assets. Peter Schiff frames this as capital rotating back toward tangible reserves. The next point connects private demand with bond market instability.
And so I think that's going to open up more private sector demand for gold now that, the air is coming out of the Bitcoin bubble. So it's really a perfect storm right now for gold, and even better for the mining stocks, I think.
When we were talking earlier about the bond market issues and the potential for a crisis, there is a potential here for a disorderly bond market collapse due to the debt situation and the purchasing power destruction that you were talking about earlier. Do you believe it's in the best interest of the U.S. to see gold's price rise to much higher levels in order to give coverage to make it more palatable for foreign governments to buy treasuries?
No, I mean, I don't think it serves the near-term interest of the U.S. to see the price of gold go up. In fact, I think that one of the reasons that you had this big selling in gold and silver when gold was above 5,500 and silver was 120, I think the government may have orchestrated that because they were worried about the message that soaring gold prices were sending.
Gold prices sometimes communicate economic stress more honestly than official policy statements. Peter Schiff connects rising metals prices to bond market fragility, particularly with US debt surpassing $34 trillion and Treasury issuance accelerating into 2026. When gold rallies during rising yields, it signals declining confidence in fiat purchasing power rather than inflation hedging alone. Mining equities historically outperform metals during early crisis cycles, as seen between 2001 to 2006 and 2009 to 2011. Claims of coordinated price suppression reflect long-standing skepticism about futures market leverage and policy optics. Peter Schiff frames gold strength as a credibility signal policymakers prefer muted. Next comes the deeper issue, confidence in the dollar itself.
It really was a vote of no confidence in the U.S. economy, in the Fed, in the Treasury, and the dollar. And, the stronger gold gets, the weaker the dollar looks in comparison to gold. Gold is the primary competitor for the dollar, not the euro or the yen or the RMB. It's gold. And gold prices just going up like this is a bad sign. And, the government, obviously, rather than addressing the problems that are causing the price of gold to go up, they would rather, stop the price from going up or try to deflect people's attention to it, because they're never going to get to the underlying problems until they have no choice, because there's a complete economic, crisis, which fortunately or unfortunately, depending on your perspective, is going to happen. So we're going to have the crisis. Whether or not we do the right thing is anyone's guess. But
are you expecting
the only way we're going to do the right thing is if a crisis forces us to do it.
Are you expecting the crisis to begin hitting this year?
Currency credibility rarely collapses suddenly. It erodes gradually through policy choices and debt expansion. Peter Schiff emphasizes gold's role as a competing monetary benchmark rather than just a commodity investment. Historically, gold's strength during fiscal expansion periods, like post-2008 quantitative easing, reflected declining real interest rate confidence, not just inflation fears. The Federal Reserve's balance sheet remains above $7 trillion even after tightening cycles, and Treasury refinancing needs spike through 2026 to 2027. Investors often ignore these structural pressures until markets force repricing. Peter Schiff views crisis-driven reform as historically consistent with monetary resets. What follows is timing, when markets finally react to these pressures.
It could, I mean, it could hit this year. It could hit next year. I mean, I don't know. I mean, it's been long overdue, but I think the action in gold is signaling that we could be a lot closer now, finally. And I think, what has happened, not just under Biden, but in particular under Trump, I think is accelerating a long overdue move out of the dollar. I think we really gave foreigners a kick in the ass to get them to do what they should have already done, which is ditch the dollar, move away from the dollar. And I think, Donald Trump appreciates how bad that's going to be. But given that, I don't know why he poked, so many bears with all this. The world is taking advantage of us. The world is screwing us over, when that's not what's happening. The world has been subsidizing the U.S. economy. They supply us with goods that we don't produce. They loan us money we don't save. Our entire consumer-based, debt-fueled economy is completely dependent on the world financing it.
When gold signals stress, while politicians argue trade narratives, the currency system is quietly shifting. As Peter Schiff suggests, de-dollarization isn't ideological. It's arithmetic, especially with US debt above $34 trillion and net interest costs surpassing defense spending in 2024. Foreign holdings of treasuries have stagnated since 2021, even as issuance accelerates into 2026 refinancing cycles. If global trade partners reduce dollar exposure even modestly, funding pressure rises and yields follow. This isn't partisan, it's balance sheet reality affecting bonds, equities, and mortgage rates. Peter Schiff warns the adjustment could be faster than markets expect. Next, the conversation shifts from currency risk to systemic economic vulnerability.
And if they stop doing that, which they should have stopped a long time ago because it's not in their interest to continue this, but the sooner they stop, the sooner our whole phony economy implodes, which in the long run is a good thing because, it's going to implode eventually. And the longer we delay it, the worse it's going to be. So, better now than later. But nobody is prepared for this. Nobody expects this. Nobody understands that this is what's coming.
All right, Peter, let's move over to silver. It's under tremendous supply strain after 5 years of a deficit and the increase in demand from everywhere you look. Data from the COMEX, LBMA, Shanghai, they all show depleting supply levels over the last year. Modern civilization and military require silver. There's just no alternative. Yeah. It's under tremendous pressure from paper games, as you were talking about, being played by very large players.
Equity optimism persists while underlying trade and supply dependencies grow more fragile. Peter Schiff frames the economy as externally financed, and the numbers support the vulnerability. The US runs persistent trade deficits exceeding $700 billion annually. If foreign capital inflows slow, liquidity tightens quickly, pressuring risk assets and credit spreads. Meanwhile, silver's 5-year supply deficit coincides with rising industrial demand from solar and defense applications. Inventory drawdowns across major exchanges suggest tightening physical conditions beneath volatile futures pricing. Peter Schiff implies that when confidence falters, hard assets reprice abruptly. Now the focus turns to silver's volatility and what it signals for 2026 positioning.
There's a lot of volatility, and the last month has been incredible to watch. It's whipsawing many investors, but what's your base case for silver for 2026?
Yeah, look, we're still seeing silver, swing, drop $10 in 5 minutes. But the important thing is, where is all that volatility taking place? $80, $85, $90 down to $70, $75, way above what used to be resistance at 50. So we just blew through the double top area. And so this is just a lot of volatility now that silver has finally broken out of this decades-long slumber. And yeah, I mean, there is some supply now because, Americans are broke. And so they're going down to the pawn shop with their silverware and their candlesticks and, whatever they got that's made of silver. And they're getting decent money out of it, right? But once that supply is exhausted, right, not everybody is going to go sell their family heirlooms. Some people are going to hold on to it so they can continue to pass it on to future generations. But
volatility feels chaotic, but price location tells the real story. As Peter Schiff notes, silver swinging between $75 and $90 is happening far above the former $50 resistance that kept rallies for over a decade. Breakouts after long consolidations, like gold in 2005 or 2019, historically bring sharp retracements without breaking structural trends. Short-term supply from household selling is marginal compared to annual industrial demand exceeding 1 billion ounces. Investors must distinguish between tactical swings and secular shifts. Peter Schiff suggests the real question is endurance, not daily price noise. Next comes the supply constraint that could define silver's longer-term trajectory.
there are some Americans that are in a lot of trouble. And if they can get 25, 50 grand by selling their fancy silverware that they hardly ever use, that's what they're going to do. I mean, I remember when I got married the first time and silver was under $5. And I was, this a great time to get silver because I knew like, hey, I mean, it's made of silver and it's only $5 an ounce. And it's not a bad, a lot of people have made more on their silver wear than on their stock portfolios now. But, we're going to run out of that, that bit of supply, which is minimal in the scheme of things. And, I mean, the thing about silver is when price goes way up, it's not like the mines could just supply a bunch more silver. It's different in, let's say, in agriculture. If all of a sudden there's a lot of demand for soybeans and soybean prices go way up, farmers could just plant soybeans instead of corn or instead of wheat, right?
Temporary scrap selling can't offset structural production limits. Peter Schiff highlights a key economic truth. Unlike agriculture, mining supply can't scale quickly with price. Global silver mine output has grown only marginally over the past decade, constrained by permitting, capital costs, and declining ore grades. Even if prices double, new projects often take 7 to 10 years to reach production. Scrap supply spikes during economic stress are short-lived and represent a small fraction of total demand. Peter Schiff implies that price ultimately must ration consumption when supply elasticity is limited. What follows will test how markets clear when industrial demand collides with constrained production.
They can start focusing on supplying more of the commodity that has higher price. But with silver, I mean, yes, if silver is really high, it will result in companies spending more money in, exploration and development projects to try to find the silver. But that's going to take a long time to even happen. So the extra supply that we may get in response to the higher prices could be 5-10 years into the future. So
much longer.
The only way that the market's going to clear is with higher prices. That's it. And that's going to reduce demand. But the problem is, as higher prices reduce industrial demand, they actually increase investor demand. Like investors want to buy more as the price goes up. So it's really going to be a problem. And obviously for companies that really need silver, they're going to have to buy it. But in some cases, they might say, well, let's use copper. Well, okay. Well, copper's at record highs too, and copper prices. I mean, no matter what metal you want to substitute down to, the price is going to go up and the supply problems are the same.
Exactly.
We don't have any new copper mines that we could just tap into.
Commodity markets don't balance through production first. They balance through price. As Peter Schiff points out here, mining supply cycles lag demand by nearly a decade, meaning today's shortages reflect investment decisions made years ago. Global silver production has grown less than 1% annually since 2016, while industrial demand continues rising with electrification trends. When investors and industry compete for the same material, price discovery becomes volatile but directional. Substitution rarely solves shortages when multiple metals face similar constraints. Peter Schiff suggests price must ration demand before supply responds. Next, mining stocks enter the conversation as earnings begin catching up with metal prices.
And then you have the price insensitive buyers like the governments that are stockpiling. So Peter, the HUI index sits about 10% or so below its highs. Gold itself is about 10 or 11% below its high. The HUI began the year around 700. It's up 21% year to date, which would make for a great year. Although because of the recent price action, it almost feels like it's down to start the year. It's a really strange environment that we're in. But, now we have the miners. They're reporting fourth quarter earnings based on much higher metal prices. Some of them are just absolutely killing it versus the third quarter. Then the first quarter of 26, as long as there's no price collapse in the metals, the prices are going to be even higher in the first quarter.
Look,
do you view the miners currently as fairly valued or undervalued?
well, I think they're still undervalued. I mean, ironically, they're more undervalued now than they were a year ago before they tripled. Because a year ago, I still thought they were cheap. But I anticipated that the gold prices would go way up.
Strong yearly gains can still mask valuation gaps when earnings accelerate faster than stock prices. Peter Schiff highlights how gold miners' profitability is only now reflecting higher metal prices in quarterly reports. If gold producers generated record free cash flow in late 2025 earnings releases, forward PE ratios for many miners remain below broader market averages near 20x. Historically, mining equities lag metal price moves early in bull cycles, before catching up through earnings revisions. Investors often underestimate operating leverage when commodity prices rise. Peter Schiff argues the valuation reset may still be incomplete. Next comes the role of analyst expectations in keeping mining stocks discounted.
The reason investors didn't want to buy them is because they didn't share that opinion. Most people a year ago thought gold was going down. In fact, I remember when gold first hit 2000, you had a lot of the Wall Street firms put sells on Newmont and Barrick because they said, well, gold's at 2000. It's got no place to go. It's at the top. And the whole way up, the analysts just never believed in the rally. So they never adjusted their earnings estimates. And so stocks are valued based on the discounted future earnings to today. And if you don't believe they're going to have high earnings in the future because you think gold and silver prices are going to crash, then you're not paying up for these stocks. But right now, I still think that many people are in disbelief of the current prices. They still expect gold and silver prices to drop, but maybe they don't think they're going to drop enough so that now they're comfortable. Okay, maybe gold goes to 3,500, right? So that's still like they still have to up their estimates, right?
Analyst skepticism often lingers long after market trends change. As Peter Schiff explains, valuation models depend on forward earnings assumptions, and many analysts underestimated gold's move from $2,000 to much higher levels. Mining stocks tied to companies like major producers historically re-rate only after multiple quarters of strong earnings force estimate revisions. This lag happened during the 2003 to 2007 commodity cycle, and again after 2019 gold breakouts. When analysts revise forecasts upward, institutional capital usually follows. Peter Schiff sees disbelief itself as a bullish indicator for mining equities. Next, the cost structure of mining companies becomes the overlooked catalyst.
But I think not only is the street wrong to assume that gold and silver prices are going to go down, I think they're also wrong in not assuming that they're going to keep going up. Because everything that they didn't expect, which has driven gold from 2,000 to 5,000, that's not going away. And silver finally broke out. And, a lot of these gold companies, I mean, pretty much all of them mine silver. But where silver comes into the earnings is it reduces the cost of the gold. And so I think what's going to happen is you're going to see companies, not only with a higher top line in their revenue, but their costs are going to go down because they're getting so much money for the silver, which is a byproduct. And in case you haven't noticed, oil prices at just over $60 a barrel, they're very cheap historically relative to gold. This is about the cheapest oil's ever been. I mean, you can't count like a couple of months in COVID when oil went negative. But oil at 60 with gold at 5,000. So that gold companies are making a killing.
Rising commodity prices don't always mean rising production costs. Peter Schiff points to a rare margin expansion scenario where gold revenues rise while input costs like energy remain relatively low. Oil, near $60, significantly reduces mining fuel and transportation expenses compared with past commodity booms like 2011. At the same time, silver byproduct credits lower all-in sustaining costs for many producers, boosting profitability per ounce. Earnings leverage in mining companies can expand faster than metal prices themselves. Peter Schiff believes this margin dynamic could surprise equity investors.